Good morning, students. My name is Mr. Philip Tawana. I'll be presenting to you the subject accounting. There we go. You have my details there. Total details, Mr. Philip Tawana. Contact number is given there, 0812702296. My email address, pmilinga@gmail.com. I already greeted you. Welcome to accounting subject school model. I wish all the best in this model. This model is just a brief presentation on the subject content for this model, preparation for your 2022 examinations. We are going to look at, or I'll present the following contents. We shall look at the brief main important concepts covered. We shall look at bank reconciliation statement. We shall look at the general journals. We shall look at creditors control account and payment period. And we shall look at debtors control account and collection period. We'll also look at partnership account, the goodwill account, capital account, income statement account. Lastly, we shall look at manufacturing account. Let's go in detail with our presentation. Concepts. We want to look at what is accounting equation. Accounting equation simply means assets equals to owner's equity plus liabilities. What is auditing? Auditing simply means recorded information in a true reflection found. What is depreciation? Depreciation refers to the loss of the value for assets in a business over a period of time. What is non-current assets? Are properties lasting longer in a business? What is trial balance? Trial balance shows a list of accounts on debit and credit side. Capital receipts, it simply means all money received when an asset is sold. Uses of computers in accounting, it's quite often used for database, for reports, payrolls, spreadsheets, source document, and many other examples. Revenue expenditures refers to all expenses incurred to run the business. Liabilities is a debt owed from one company to a person or company that is not an owner of business. Let's move to the second point of our presentation, which is bank reconciliation statement. First of all, we need to understand the steps. How do you go about reconciling your bank with your cash book? You need to update or to make sure that your cash book is updated, and then you proceed to the bank statement to see if they are going to agree at the end of your financial period. As I said earlier on, the first step you do, update your cash book by balancing it off. Then you will see that you have to proceed to your bank statement there. Depends on the balance per cash book. if your balance per cash book is a debit balance, it will move to the credit side of the bank statement or bank reconciliation statement. If your cash book balance is on the credit side, you are going to put it on the debit side of your bank statement. Then you update the missing figures which are not recorded in the bank by bringing them down. Transaction like debit unpresented EFT payment, or the payment that were not processed to the bank, must be brought under the debit columns, and all outstanding deposits that were not presented in the bank must be brought to the credit side of your bank statement. Now, the bank balance statement, it will depend which side is bigger. Your bank balance might be on the credit side or on the debit side. Now, once your final bank balance is on the credit side, it means you have money in your bank account. But if your final balance in the bank is on the debit side, it simply means you're owing the bank. You do not have money in your bank account, so you're owing the bank. I would like to urge you to read further on these steps on how to do bank reconciliation statement. You must take note of the steps that I have indicated there. You have to make sure that you bring your cash book first updated, then you check missing figures that are not reflected or recorded in the bank statement, then you update your bank statement. Depending on the balance, your final balance might be on the debit side, which is an overdraft that you're owing the bank. But once your final balance in the bank statement or bank reconciliation statement is on the credit side, it means you have money in your account. Let's proceed to the next topic. The general journal. Firstly, you need to understand the general journal. It means what? It refers to a book of original entries in which accounts and bookkeepers record raw business transactions in order according to the date events occurred. Or the general journal, in short, it records all transactions that do not fit in any of the financial books, such as purchasing of fixed assets on credit, drawings, you name it. Say, for example, what is important is to know how do you record a transaction in the general journal. For example, given the transaction there, donated some goods to Cosmos Primary School, 7,000. How do we record this transaction? Firstly, you need to identify the two accounts involved there. It's donation and goods. The account is purchases, so it's donation and purchases. So we are going to debit donation and credit purchases. If the instruction says write down the narration, you must write in brief what is the transaction all about in bracket. Here is written donated goods to Cosmos Primary School in brief. But remember to do a lot of practice on this topic. Transactions that are recorded in the general journal, and how do you record transactions in the general journal. You must read the rules and able to know which accounts are recorded in the general journal. Let's move to the next topic. Creditors control account and payment period. What you need to understand here is what is the purpose of this creditors control account, we want to check the accurate or correctness of recording or keeping for final accounts to do with the creditors. We want to find out the payment made by creditors by the end of the period. And now you must know what accounts are recorded here on the debit side and what accounts are recorded on the credit side. You must remember that the credit account have got opening balance on the credit side there, and it always increases on the credit side, meaning all the purchases, total purchase must be on the credit side. All the cash received must be on the credit side. And on the debit side, you put all purchase returns, the bank payments, discount received. Then you see your closing balance will be on the debit side. So that the following month, your closing balance on the debit side moves to the credit side as your opening balance. Now, how do you calculate the payment period? You take the total value of trade receivable or the amount of creditors. Trade receivable is called creditors. You multiply with the number of days, which is 365 days. Divide by credit sales over 1 day, and also you divide there by 12 months to find out how many days. But it's preferable if your days that are more than 60 days, meaning your payment period of data is good. So it should always more than 30 days. So it's advisable that you have payment period for creditors to be more than 60 days, which is equivalent to 2 months. Now let's look at the debtors control account and the collection period. We must also understand what is the purpose of debtors control account. Is to check the accuracy or correctness of record keeping in this final account and preparation towards our final account. So what we have looked at previously on the creditors account is the opposite of what we are going to do here. Remember, creditors increase on the debit side, meaning our opening balance must be always on the debit side. You put your sales on the debit side, or the bank EFT payment cancelled on the debit side. Now on the credit side, you put all the bank received, the cash from the debtors, sales returns, discount allowed, bad debts, and your closing balance will be always on the credit side of your debtors control account, so that the following financial period or the next month, this closing balance, which is on the credit side, it goes at the debit side to become the opening balance in your debtors control account. Notably, we need also to understand or to know how do you calculate the collection period for debtors. So you will be given, or you must put your trade receivables, which you put there, which is your total debtors. Trade receivable refers to total debtors. You multiply with the number of days, which is 365 days. Divide by 12 months, and here divide by credit sales over 1. And it's preferable that your days should be less than 30 days. So the collection period for people who are owing you should be a month, or not more than a month. Should be less than 30 days is equivalent to a month. So it should be less than a month. So if you have a collection period of your debtors, it means you are likely to be at the risk side because they might take longer to pay your account. Therefore, you must insist payment period of debtors or collection period of debtors should be preferable less than 30 days or 1 month. Let's move to the next topic, partnership account. You need to understand first what is the partnership account and what is a partnership account all about, or what is the purpose of preparing a partnership account. First, a partnership is a business formed by 2 to 20 people to maximize profit. Importantly, is to share profit and losses in the agreed upon ratios. The format is almost the same like any other income statement or trading account, because if you look at it carefully there, you see that in partnership we do the same format like income statement or trading and profit loss account, because you want to find out what is the profit the business made thereafter, or loss the business made thereafter. The partners, they must share the profit or loss. But the rule says this profit and loss sharing is based on the contribution of capital. The one who contributes more capital, he gets more share than the one who contributes less capital. If you look at this example here, a business formed by 2 or more people to make more profit, sharing of profit or losses. There are 2 people here. There is Peter and Julia. They share the profit or loss in a ratio of 2 to 4. Therefore, you are going to calculate the profit sharing based on the ratio of 2 to 4. You add 2 plus 4, give you 6. So it will be 2 over 6 for Peter and 4 over 6 for Julia. Now let's look at this scenario of the trading account, what happened there. So here you are given opening stock of 8,000. You are given the purchases added to the opening stock. And then you are given closing stock there of 3,400. When you minus this, you get the cost of sales of 25,600. And then you subtract it from the sales given here, 4,000. Then you get a gross profit of 14,400. Then you list all the general expenses or all the expenses incurred in a business. Here only given a general expenses of 5,300. And now you say gross profit of 14,400 minus general expenses of 5,300. You get a net profit of 9,100. Now this 9,100 is what Peter and Julia should share in a ratio of 2 to 4. Now, if you look at it here, we are going to say Peter, he will take 2 over 6 of that 9,100. So it will be 9,100 times 2 divided by 6. Peter will get how much? 3,033 and 33 cents. While Julia would take 4 over 6 of that 9,100. That means it will give Julia an amount of 6,667 cents. So if you add these two, the share Peter got of 3,033 and 33 cents plus this 6,066 and 67 cents. The two will give you 9,100. But you can do some practice in your modules or any other reference book that you might find to get more exposure or to gain more experience on this type of partnership account calculation, so that at least when it comes in the examination you have prepared and you are ready for it. Let's move the next topic there, goodwill account. We must first also understand what is goodwill account, or what is goodwill. Goodwill is built up in the business by existing partners, and any new partner entering the business will benefit from these assets developed before entering the partnership. They will say good name of reputation or record. But in simple terms, goodwill simply means the difference between the purchase price of the business and the total value of assets in the business. When the business is sold, or when another partner is buying a business, the value of assets minus the selling price is what makes the goodwill. If you do more reading, you see that the goodwill, it will benefit the partner who is going to join. If the value of the asset is higher than the selling price or purchase price, then the new partner entering the business will have benefited from that selling of your existing assets or business. Now, if you look at it here, in terms of capital, goodwill account, there are two partners faced here who are in business, Maria and Penda. Maria had a capital of 7,500, or both they had same amount of capital, 7,500. But now, when the new partner joined, Maria had 6,000, Penda 6,000. New partner Eric had 3,000. Now you can see that if you look at it carefully here, there might be some benefit, not much, because the value that Eric, or the contribution of Eric, is not too much. So it depends on the contribution of a new partner. So in this case, there's a slight benefit, but not much expected from the selling or contribution of these capitals. But if you do another activity, you'll see if the value of the assets that been sold is higher than the purchase price or the contribution of the new partner. The new partner, or partners, all partners are going to benefit. So it depends on the purchase price of the assets and the contribution of the new partner. So it will depend. Now, if you look at the capital account, it will show the contributions of partners in business. So we are saying the more you contribute, the more you benefit. Now look at this capital account. We bring down the balance of 15,000 from that goodwill account. Look at Maria contribution is 8,000, Penda is 9,000, Eric is 7,000. The goodwill is 5,000. Now, if these compared the previous account of goodwill, you will see that the amount contributed by Eric 3,000. Here in the next capital account, it has increased from 3,000 to 5,000. It has increased by 2,000. So we are saying the higher the contribution, the more partners all benefit, or the higher the price of total assets compared to the purchase price. If the purchase price is less than the cost of assets in the business, the goodwill will be higher. It means the new partners, or all partners, are going to benefit. So in this case, we can see there's a slight increase in terms of capital contribution. That means the goodwill also, it will increase. The more you contribute, or the more the total value of asset is compared to the purchase price, your goodwill will increase. So I'll urge you to do some practice there but understand the rules. The higher the value of asset compared to the purchase price, the goodwill will increase. Or the higher the contributions of partners or new partner, the goodwill will increase. So if you read further, you will see that it's based on the contribution in terms of increment or the purchase price versus total value of assets in the business. Now let's look at the next point, which is income statement. Income statement account, it can be, this one is for profit-making business. So you're saying, what is an income statement? Is a financial statement that shows the company's income and expenditures in terms of profit-making or loss. So it must show whether the company is making profit or loss in that financial period. Normally, there are formats on how to prepare income statements, but it's more advisable to prepare your income statement in a vertical format, meaning you put all the details on your left side on one line, but you draw two columns like a trading account, but all the accounts must be on your left side on one line. If you look here, you are given the sales here, go that side, 50,000. Okay, normally we start opening stock. You have your opening stock here, 10,000 there. Add purchases, 20,000. Less closing stock of 12,000. Then you get 18,000 there. 18,000, so sales minus 18,000 here. Then you get your gross profit of 32,000. You less the expenditures given, 23,000 there. From this gross profit, you get a net profit of 9,000. But you can do this by practicing different activities. But you need to understand that income statement is prepared using the vertical format. You put all the account details on your left side on the straight line. I'll urge you to do more activity on that one to see if you can master all the steps. Let's look at the last point of our discussion for today, manufacturing account. Manufacturing account, firstly, we need to understand what is manufacturing account. Manufacturing account gives information on all the expenses and costs incurred in the preparation of the goods to be sold. So you must know all the costs involved in producing or manufacturing goods in your factory. So it's about what are the costs or expenses incurred to produce goods that you need to sell. This includes expenses that are made in path of preparing the goods, but not the finished goods. So manufacturing costs are composed of three major elements. It has direct labor, raw materials, and overhead. So let's look at this manufacturing account using these three elements. The direct labor that is involved, material involved, and overhead expenses. These overheads are expenses that are incurred in the production of goods in the factory. Direct labor and materials that are used to produce at the beginning of your process of producing goods. But if you know these three sections, now you can prepare your manufacturing account. Let's look at it. Have a business there making goods by using machineries, and labor is on larger scale, e.g. you are given the opening inventory of raw materials there, 42,000 there. You add purchases of raw materials, 38,800. You also add carriage on raw materials, 2,700. Now, you less or subtract closing inventory of raw materials of 26,200. Then you get this 57,300. 300 It's the cost of raw materials used or consumed. Now when you finish, these raw materials, you add it to you say raw material consumed or raw materials. Add it to direct labor, add it here. Say this 57,300 plus 112,400, it will give you prime cost. Prime cost here is to be 169,700. And then you add factory expenses or overheads. You add them there. That's the step. Add it to 169,700. You add 78,285. Then you add your opening inventory of work in progress, 7,400. And then you minus or you subtract closing inventory of work in progress end of the year, 8,600. Then you get the production cost of completed goods of 246,785. So you need to understand the steps. That first you have to list down have to calculate the cost of raw material consumed, add your direct labor, then you get prime cost. Prime cost, you add all factory overheads. The last part of it is just a guide or some tips on how to prepare for exams. Have all materials required for your preparations. Have sufficient time to study. Form group or Zoom discussion classes. Consult some fellow students and your tutor. Your tutor. Revise all your assignments. Make a thorough examination preparations. Work very hard. Answer all questions in the exam paper. All the best and good luck for your exams. That is the end of our PowerPoint presentation. Have a nice day.